All right, let's get right into it. Think of this as a kind of financial checkup, a way to diagnose what's really going on with your money. We're going to measure what actually matters, real wealth, not just the flashy stuff.
And honestly, this quote just nails it, right? We are so bad at telling who's genuinely rich from who just looks rich. The gap between what we see and what's real, it's huge. You see the fancy car, the big house, and your brain just jumps to conclusions. And 9 times out of 10, those conclusions are dead wrong.
Okay, so let me paint you a picture. Imagine you're at a backyard barbecue. This guy, let's call him Brad, rolls up in a shiny new Range Rover, the $95,000 model. Everyone's heads turn. But then, over in the corner is your other buddy, who drove up in a 10-year-old Toyota Camry he bought with cash. Now, what nobody sees is that the Camry driver, he's sitting on over $1 million in investments. He could literally retire tomorrow. The Range Rover guy, he's drowning in lease payments. That is the crazy difference we're digging into.
And it all boils down to this concept, the great wealth illusion. See, we live in an economy that is obsessed with selling us the performance of wealth, all the stuff you can show off. But the real path to building actual wealth, well, that's invisible, so it just gets completely overlooked.
And look, this isn't just a hunch. The data is pretty shocking. A study from the University of Chicago found that the upper middle class spends, get this, a staggering 43% of their income on what they call positional goods. Stuff that screams, I've made it. But the genuinely wealthy, just 18%. Think about that for a second. The people who can least afford to play the status game are the ones playing it the hardest.
So, you ready? It's time for a little wealth audit. I want you to keep a running score for yourself as we go through these 7 tests. And here's the deal. If you score a 5 out of 7 or higher, I'm telling you, you're on the right track. You're building real, lasting wealth, and it doesn't matter one bit what your neighbor is driving.
All right, let's kick things off with test number 1. This one is probably the most math-heavy, so buckle up. It's called the engine-to-equity ratio. And fair warning, this one can be a little brutal when you actually run the numbers.
So here's how you figure it out. First, add up the resale value, what you could get for them today, of everything you own that has an engine. Cars, boats, motorcycles, the whole shebang. Then you divide that number by your total invested assets. That's your 401k, your brokerage accounts, all the money that's actually out there working for you. Your target, you want that number to be less than 5%.
Let's go back to our buddy Brad from the barbecue. He's got, say, 125 grand tied up in vehicles, but his 401k, only about 70,000. Do the math. His ratio is a mind-blowing 179%. He has almost twice as much money in stuff that's losing value every single day as he does in stuff that's growing. It's a financial trap. But now, let's look at you. You're driving a solid, reliable used car worth maybe $12,000, but you've been socking away money and you've got $200,000 in investments. Your ratio? 6%. Yeah, you're a tiny bit over the goal, but who cares? You fundamentally passed this test. Your financial engine is absolutely pointed in the right direction. And this is where it gets crazy, because this stuff compounds. Look at this chart. In just 3 years, Brad's vehicles lose 40 grand in value. His investments gain a bit, but his net worth actually drops by $22,000. Now your car loses a little, sure, but your investments grow by 52 grand. Your net worth is up 49,000. That's a $71,000 wealth gap that has opened up between you and Brad, all because of this one single ratio. All right, test number 1 is done. Let's move on to test 2. This one's less about math and way more about psychology. I call it the invisible brand metric. And the big question here is, are you paying what I like to call an insecurity tax? The test itself is really simple. Ask yourself this: could you walk into a room full of successful people without wearing a single visible logo? If you feel like you need that Gucci belt or that Rolex watch just to feel like you belong, you're paying for that signal. And the price tag? It's nuts. The average upper middle class person spends over $6 grand a year on luxury stuff. If you just invested that money instead, over 30 years, it would grow to more than $760,000. You're literally trading a comfortable retirement for brand logos. Okay, on to test 3. Now we're getting into the really good stuff, measuring actual financial freedom. It's called the passive to burn threshold, and it asks a really simple but powerful question. How much of your survival is basically automated by your money? So here's the goal. Add up all your monthly passive income. Dividends, interest, any money that comes in without you having to work for it. If that number covers at least 25% of your basic, bare-bones living expenses, you pass.
And even that little bit, that 25%, it creates this incredible psychological safety net that most high-income earners just don't have. It gives you choices, it gives you leverage, and way more real security than someone who's totally dependent on that next paycheck.
Test number 4. This one really gets to the core of your entire money mindset. It's the boredom indicator. And it's a choice. Is investing entertainment for you? Or is it just quiet, boring infrastructure? Look, people who just look rich treat investing like a trip to Vegas. They're day trading, they're chasing crypto pumps, they're bragging about their hot stock picks at parties. But the actually wealthy, they treat it like paying the water bill. It's a utility. They set up automatic, regular investments into boring, cheap index funds, and then they just forget about it. It's just infrastructure humming along quietly in the background, building wealth with zero drama.
And again, the numbers don't lie. Look at this. From 2000 to 2020, the S&P 500 itself returned over 10% a year on average. But the average investor, they only got 5.9%. They got crushed, underperforming by almost half. Why? Because of all that emotional trading, all that entertainment. The lesson is crystal clear. Boring wins.
All right, let's tackle tests 5 and 6 together, because they're really two sides of the same coin. They both measure true financial freedom. This is all about having options and having what I like to call economic breathing room.
So test 5 is the no power index. The question is, could you live your life exactly as it is right now for 2 whole years if you lost your job tomorrow? A 2-year runway. Man, that gives you almost unlimited power and choice. Then there's test 6, the low fixed cost floor. Are your must-pay bills, your mortgage, car payment, utilities, less than 30% of your take-home pay? That is what creates economic oxygen.
And this chart just shows it perfectly. If 70% of your paycheck is already spoken for before you even get it, you're financially suffocating, even if you make a ton of money. But flip that. If only 30% is going to fixed costs, you've got this massive 70% of your income as oxygen. That's freedom. That's flexibility to invest, to save, to deal with whatever life throws at you. Honestly, someone earning less money but with more oxygen is in a way better spot.
Okay, we're at the final test, number 7. And this one might be the most psychological of them all. It's the social validation silence test, and it's designed to reveal the real why behind what you buy.
And the test is a simple question you have to ask yourself. In the last 6 months, have you bought something significant, a vacation, a new gadget, whatever, and just enjoyed it for yourself without posting it on social media for everyone to see? If you find that you can't really feel the joy from a purchase until you get those likes and comments, you're not actually buying the item, you're buying the reaction. And believe me, that is one expensive and empty trap to fall into.
So, that's it. Those are the 7 tests. Take a second right now and add up your score. How'd you do? Are you a 5 or higher? If you are, then congratulations. You are genuinely building real wealth, and it absolutely doesn't matter what anybody else thinks or sees.
So where do you go from here? 3 simple steps. First, calculate your score and be brutally honest with yourself. Second, pick the one test where you did the worst and just make a simple 6-month plan to get better at it. And third, and this is so important, find an ally. Find someone else who gets this stuff. Building wealth this way, the quiet way, it goes against everything society tells you to do. You're going to need someone in your corner.
Because in the end, that's really the whole point. The validation you're looking for, it's not going to come from Instagram likes. It comes from the inside. It comes from looking at your account balances, from knowing you have options, and from the stress that you don't have to feel every day. Real wealth truly is invisible. And real freedom, it's quiet. And that quiet confidence, knowing you're secure no matter what, that's worth more than any fancy car or designer watch you could ever buy.